Credit. How do you win at the game of credit when no one tells you the rules? Well, that's what we're going to talk about today on Just My Opinion. This is Jessica Duncan's Just My Opinion, and I'm Jessica. There's no handbook to owning a home. That's why I go beyond the transaction to share my opinion for adulting made simple. All right, so let's talk about credit. It is crazy to me that ultimately in life, to succeed and have wealth and build wealth, you have to learn this game of credit. But no one ever teaches you the rules. You probably never had a class in school that taught you about credit, how to build your credit, how important it was, what makes your score go up, what makes your score go down. But ultimately, we gotta know this to succeed in life and be able to buy a house, to be able to leverage, to invest in businesses or in other properties. So we're gonna talk a little bit about these rules to help you understand the insights to win at the game. So a lot of times when I meet with people, one of the things that they want to do immediately is pay off all debt. Well, if you're looking at buying a house, that may not be the best thing. But then again, it may be that you have to pay off that debt. It sort of depends on what type of debt it is and where it's at. So let's talk about paying off old debt. Sounds like a great thing. Sounds like it's going to improve your credit, right? But not always. It will sometimes improve your credit, but sometimes it will pull your credit down. So the reason why is, let's say you have an old medical bill that's maybe 7 or 10 years old on your credit, and you go and pay it off today. Well, now it's coming up active where it may not have been active on your credit prior to you paying it off. So it could actually pull your credit down. That's a weird thing that people don't think about. How could my credit score go down by paying off an old debt? So before you do something like that, if you're looking at making a major purchase, you always want to talk to a lender and make sure that what this effect is going to have on your credit. And talking about medical bills, so there's a lot of mixed information out there about medical bills. Some people will say, well, medical bills don't affect your credit. Well, if you have no credit and all you have is default medical bills that are defaulted in the last couple years, yeah, that could affect your credit. But if you have some good credit and then you've got these old medical bills from 10 years ago, it may not be affecting your credit. So there's a lot of mixed information about those medical bills. And I guess the easy rule of thumb is, if they're current in the past couple years, let's say 3 years. That's what most credit is looking back, is 3 years. If they are in default in the last 3 years, yes, they can be negatively impacting you. If they're over 3 years old, they may not be impacting you at all. But you got to have some good credit to balance it out. Another thing that really plays into your credit report that surprises people in that credit score is the length of time your accounts have been open. So one of the factors that play into the score is looking at each account and how long they have been open. So if all of your accounts have only been open for less than a year, you're not getting a huge increase because of the length of time. So one experience that will probably shock you is I paid off a mortgage and it dropped my credit score 80 points. 80 points for paying off a mortgage. You probably didn't think that was a rule. We're going to punish you and drop your credit for paying something off. But if you pay a house off, if you pay a car off, those are normally long accounts that have been established for a long time. And so they're going to lower your score when you close those accounts. So when I paid off that mortgage, that was one of the longest credits on my credit report. It was the longest open account and it dropped at 80 points. I freaked out. Luckily, it came back in a couple months and it normally will rebound pretty quickly. But if you're in the middle of a major purchase, that's something good to know. Maybe you don't need to pay off that car until after the transaction or purchase of a house or investment property. If you talk to a good lender though, they can always run a simulation to show you what is it going to do if you pay this debt off. If you pay this house off or you pay this car off, how is that going to affect your credit? And you may not want to do it right then. Who would have thought paying off debt, a mortgage, or a car is going to drop your score? Just another rule they don't teach you. So let's talk about credit cards and the rules they don't tell you about them. If you have a credit card and it has a credit limit of, let's say, $1,000. We're just going to use $1,000 for round numbers. So your credit limit is $1,000. That means you can spend up to $1,000 on that credit card, right? Do you know if you put $1,000 on that credit card and you pay it on time every single month, it's pulling your credit score down? Why? Why would it be pulling my credit score down? I'm paying at least the minimum monthly payment each month, and I'm not behind. I haven't missed a date. Why is it pulling my credit score down? So the thing they don't tell you is they give you $1,000 limit, but if you go over $500 in a balance, they're going to pull your credit score down for it. So what they want to see is that you have credit, but you're not maxing it out. You're not using all of it. So by keeping that balance under $500, it's going to give you positive credit, not negative credit. I know, weird thing. They don't tell you. You got $1,000, but we're going to punish you if you use it. So one question you may be asking is, well, Jessica, what if I want to use my credit card to make a major purchase? That may be okay, but the key point is you don't want that balance to roll over at 50% more than your credit limit. So for example, if you had that $1,000 credit limit and you needed to make a purchase of $750 this month, when that bill comes out before the due date, you want to make sure you pay it down to under $500. And since you didn't carry a balance for any length of time or past a due date of that balance being over 50%, you're probably going to be okay. So you just want to make sure all of your credit cards always stay under 50%. And just to be on the safe side, I say about 45%, just in case you accidentally forget a payment and have a late fee or anything like that, which you don't want to do. That's going to negatively impact your payment, but life happens, right? Sometimes they misapply stuff. So you want to try and keep it under 50%, but 45 just to be safe. Slow pay. So some people think that this isn't a thing. So on your mortgage, a lot of times your payment will be due, let's say the 1st, but you're not considered late until the 15th. You are late, but you don't start getting additional fees or late fees until the 15th. So some people say, well, just don't pay it until the 14th, right? Well, that will qualify you for what's called slow pay. Technically, it is late. You may not be reported to the credit bureau as past due or anything like that, but over time, if that repeatedly happens, you will be categorized as what's called slow pay. Yes, you may pay, but you take a little bit too much time to do it, and you really don't do it when it's due, but you're going to make sure you don't have any late fees, right? So don't try and work the system like that. I've heard actually some people try and recommend that. Always wait until that last deadline before you have fees. I wouldn't recommend that because that can classify you as a slow pay credit user, and you don't want that either. That's not a great thing to have. Many people out there have family members that they have co-signed for, or they helped them buy some furniture or open up a credit card. So how does that impact your score? Even if it is not your debt, if your name is on there, it can show up as your debt. It can impact you. Now that we did have some recent credit card changes where they actually have more of one primary and a secondary now. So that does help some with that. But if you are a co-signer or a secondary person on any type of loan, it is going to affect your credit. And that's not just credit card. That is also helping someone buy a car, a house, anything that has your credit score tied to it. Your social security number can impact your credit. Whether it's they don't pay the bill on time or they're slow pay, or let's say they pay all the bills on time, but that balance is real high. Or even that debt is going to count towards your debt to income if you're going to do a major purchase like a car or a house or an investment property. So be careful when you co-sign for stuff. I know there's times we want to help people out. I'm not a big fan of doing it though. If they couldn't manage their own credit, how are they going to manage yours? It's a big thing to think about. Now, with that being said, I know there's always weird exceptions. There's divorces, there's things like that happen that maybe they had no effect on. And so maybe you need to help a family member out in a situation like that. But just be cautious. No, it's affecting your credit as well. I had a client who had really good credit. Unfortunately, she did not know that her mother had used her security number to open up a Lowe's credit card. So the Lowe's credit card has her and her mom on it and had her social security number tied to it. So she didn't know it was on her credit. She was going to buy a house and she got a pre-approval from an online lender, not a great local lender, thought they were pre-approved, thought she was going to be perfectly fine. Well, as we got towards the end of the transaction, she had already spent money on home inspections, ordered a survey, paid for an appraisal, a termite inspection, only to find out she really didn't qualify. That this debt popped up and it threw her debt to income off, and she no longer qualified for the home. That's again why a local lender, though, is so important. But she had a lender online that had ran her credit and thought she was going to be okay. And then all of a sudden, her mom used that Lowe's card without talking to her. It showed up as new debt, and she was no longer able to buy her home. And she was about $1,500 out and didn't find out until about a week and a half, 2 weeks before closing. You want to talk about a devastating situation. So don't be in that situation. Think long and hard. If you do have someone on your accounts that are co-signing, or you're co-signing on someone, stay on top of that. If you're doing a major purchase, you want to make sure you know if they're about to use that card so you don't end up in that same situation. So how can you improve your credit? That's a question I get all the time. And it really depends on where your credit is at. So if you currently have credit, what I would start with is looking at your balances. So are you paying all your bills on time? If so, start doing that. That's number one. If you don't pay your bills on time, you will not have good credit. But once you're paying all your bills on time, then you want to look at what those available credits and the balances are. So remember that $1,000, no more than $500. If $1,000 is your credit limit, you do not want to have more than $500 on that account balance. So start with that. Go through each account and make sure you have paid everything down to, like I said, I prefer 45%, but at least 50% of the credit limit, that you are keeping the balance less than that. That's the number one thing that you can do besides paying them all on time to build your credit. So let's say you've got bad credit, but you don't have any recent credit. So maybe you have a bunch of old bad credit from 4 or 5 years ago, but you haven't used credit cards or financed anything. So you don't have anything to show that you're now more responsible than you were years ago. So in that case, sometimes it makes sense to actually open up a credit card, because a lot of times in those cases, they don't have any credit cards. So maybe you go to your bank, wherever you bank, and get a secure credit card, which is where you actually put the money up. So let's say I put $500 up to open this credit card. They hold the $500 and you can use from it, and then you have to pay it off, and it's showing that you can build that credit again. So you can do that. Sometimes they'll give you, depending on how bad your credit is, they may give you an actual credit card. So you want to use that credit card, but you want to use it very smartly. So you want to use it on stuff you're already going to spend anyway, right? Because we're trying to get you out of debt. We're trying to improve your credit. We don't want to go and just go shopping and buy a new TV. But I say, like your gas. You're always going to have to put gas in your car. It's not a splurge. So here's how I would do it. I would take that credit card and put $100 in gas on that credit card. You're going to have gas anyway, right? So go ahead and put $100 on that card. The end of the month, I want you to at least make the minimum monthly payment, and you can pay a little extra on it. But what I really want is over 3 months, I want that credit card paid off. I don't want you to pay it off in full at the end of the month, because if you pay that credit card off in full at the end of every month, it's not showing that you can carry a balance and pay it over time. And it's not necessarily hurting your credit, but it's not building your credit and bringing that score up. So that $100, make sure you're meeting your minimum monthly payment, but pay it over 3 months. Now don't keep adding to it every month, right? Because then you're going to go more and more into debt. Take $100, put it in gas, pay on it each month for 3 months until it's paid off, as long as you're making sure you make that minimum monthly payment. A lot of times, if you do that 1 to 2 times, it'll take your credit score through the roof. I had a friend of mine who went through a really bad divorce and needed help building his credit. So he's like, Jessica, I don't have any good credit. I got a bunch of old bad credit, but I don't have anything good. How can I build my credit? So I worked with him on this. We were able to get him a credit card, and he did this exact thing. And literally in less than a year, took his credit from like below 500s to the 700s. That is crazy. And so what is good credit? You're probably asking if you don't know. Anything above a 740 is normally considered pretty good credit. Above a 800 is even better. Normally, when they're looking at home loans, things like that, they like to see a 640 or better. So 640 is not like crazy great credit, but it's not bad credit either. So sometimes people will call me and they're like, oh, my credit's awful. I won't be able to buy a house. And I'm like, well, what's your credit score? Well, it's like a 690. I'm like, that's great. Actually, you can buy a house with that most likely. So you can definitely use those tips to build your credit. Use that credit card, pay it on time over a couple of months, and that will quickly build your credit. So hopefully you're going to follow these rules of credit to build your own credit. And if you have questions or want more insights, please DM me on Facebook or Instagram. I'd love to answer your questions about it. And if you have a question for the show, make sure you send that as well, and you just may get mentioned on the show. So let's talk about our home hack. So each week I'm going to do a home hack. And a home hack is just some cool gadget, app, Excel spreadsheet, just something that makes home ownership, building wealth a little easier, right? So this week I'm going to talk about Credit Karma. Credit Karma didn't pay me. I don't have anything to do with them, but I think it's a great website for you to use. It's free. You can log on there and you can see where your credit's at, what's impacting your credit. So our home hack this week is check out Credit Karma. It's not exactly right. It's not going to be perfect. You have a little bit of a different score when a lender pulls or things like that to buy a house, but it's going to give you a good idea and help tell you how to build that credit. So check out Credit Karma and see how you can improve your credit. And we'll see you next time on Jessica Duncan's Just My Opinion.